Let me now bring on board Phani Shekhar, Fund Manager with Angel Stockbroking. Phani, in quick time, Indian markets have appreciated by about 4% plus. After the budget, we were staring at a breakdown scenario, but considerable amount of repair work has happened in last 6-7 days. What's going on?
Good morning, Nikunj. To begin with, the fundamentals of the market have improved. Now, while this might seem a little contrasting when you look at the macro data, but purely from an index construct point of view, this year you will end up with about 7 to 8% earnings growth. And next year, you are more likely to clock about 12 to 14%. And the major reason for that is you have oil and gas and utilities, which are expected to do very well next year. So while you might have an FMCG and auto, which might not go into the negative, but deliver much lower returns than this year, but that will be more than made up for oil and gas and utilities and metals, which might be flat to mildly positive as compared to negative this year. So purely from a mathematical perspective, you are looking on a low base of 12 to 14% growth. And the market now is trading at around 13.5 times. So the downside for the market is capped. So despite huge expectations being built up before the budget and those not being typically delivered, I guess the market has got support at lower levels. And I think even if there were to be correction, I don't expect it to be deeper than 5 to 6%.
Funny, the only problem here is that Indian markets are currently hostage to global cues. Indian markets have appreciated, but we've not appreciated because of a local trigger or because of strong local macros. Globally, things are looking strong. Globally, money is moving into equities, and that is also helping Indian markets. If globally things turn around, what will happen to us?
Well, I certainly concede that a major part of the market, a major role of global flows in the market remaining at these levels, and of course the lack of domestic participation both through the institutional route as well as through the retail route has been a little worrying. Having said that, you cannot blanketly say that it is only because of global flows because we are here, because valuations at this point in time are not anywhere close to bubble territory. Typically what you associate with a flow driven market is the fundamentals are completely divorced from the valuations. That is not the case here. So even if the flows might turn around, what you might see is some kind of a correction, maybe deeper than 5 to 6%, maybe 8 to 9%. But at that particular point in time, you will again see very attractive valuations, and that might again attract some kind of long-only money globally and locally.
Funny, you've also got the IIP data which is slated today. Do you think that could significantly change or break the market mood?
I don't think so, because if you were to closely examine the budget document, the plan expenditure of the government has been completely shrunk. So the fourth quarter expectations are next to nothing. So a large part of the government plan expenditure not being there, and that will obviously rub off to the consumption side also. I don't think there is much excitement about the IIP. It might be flat to 1%, but that I don't think is going to change the market. The market, more importantly, is looking at the next year, and that we will come to know starting middle of April by looking at the commentary of the corporate side. Although I don't expect corporates to go overboard and announce new expansion projects, but still the commentary on how they are perceiving their own outlook and how the margin picture is looking will be very important.
Funny, I was just coming to that because soon we would also be staring at fourth quarter numbers. Has the market already priced in a not so special fourth quarter from corporate Inc., or do you think there could be some major disappointments this time?
I think the trend more or less was known with the third quarter, which is that FMCG is slowing down. So if there were to be some disappointment, it has to be in that sphere. So L&T coming up with lower than expected numbers or auto delivering lower numbers is not great, is not news anymore. So FMCG was an outperformer all through the year, so that is known. IT is expected to do well. Utilities and oil and gas might surprise you on the upside, but I guess the market has already started pricing that in, and they will look at policy action for sustained momentum for the next year as well. So I don't think there is much that the market is going to be surprised either on the upside or downside. As I said, you are likely to end this year with about 7 to 8% earnings growth. By the way, third quarter we delivered about 4% earnings growth.
Funny, according to the SIAM data, auto sales have slowed down considerably. Now, if that is the case, why are auto stocks still trading at elevated levels? Bajaj Auto, Hero MotoCorp, Maruti Suzuki, all of them are trading at P multiples of 15 plus based on FY14 estimates.
Well, the trend of auto sales slowing down is something that we had flagged off about 3 months back, and that was the time when we got out of positions in Bajaj Auto at about 2200. Your question is very valid, and this, to a great extent, I think is the triumph of hope over experience, because there is no way, when I look at the estimates of Maruti on the street, they are ranging anywhere between 16 to 18 times price earnings multiple on an EPS growth of 25 to 30%. Now here you have a company that is struggling to maintain its volume growth at last year's subdued levels. And you have the street which is giving it 25 to 28%, mainly because on the back of yen. I think these estimates will be crunched down very sharply over the next quarter or so. I don't even expect that to linger for 6 to 9 months. Over the next quarter, you will see sharp contraction both in PE multiples and earnings forecasts, which might actually see these stocks coming down by 10 to 15% at a minimum level.
Funny, what are your thoughts on DLF 286? Is it safe to assume that DLF has a strong base in place and fundamentally the storm has come and gone for DLF?
Generally, real estate would tend to do well in times of economic boom. So all the real estate action that you saw in the last rally of 2003 to 8 actually coincided with GDP growth rate of consistent GDP growth rate of 8% plus. Now, the general consensus being that it will take us at least 2 to 3 years to reach that kind of growth. So real estate in certain pockets, certain geographies, such as in South where IT is doing well, has been going good. But apart from that, the geography in which DLF and say Unitech are strong, that is the northern belt, I don't think you can expect much, at least from a top-down perspective. Yes, DLF has been trying its bit to reduce its debt, but I guess it's too little and too late in the day. And the street actually has been very benevolent with DLF with the kind of multiples that it is assigning, because it will be, as you correctly pointed out, a while before it can realistically bring down that debt. And earnings may not be the right way to look at many of these real estate stocks, because there is a huge optical illusion there. Ultimately, how much cash flows into the bank is the real determinant. So I would safely give the entire real estate and especially DLF a pass.
Funny, you just talked about as to how the weakness in some of the sectors in terms of earnings is already priced in, and you did talk about the consumption theme. We've talked about autos, but what about the rest of the spaces, the likes of a Jubilant, Titan, etc.?
Well, generally the weakness has starting third quarter. And I expect this trend to continue at least till the middle of this year. Now, FY14 is going to be a very curious year, because you cannot be taking a call for the entire year. You have to divide it into two parts. In the first half, you will have spaces related to active governance, such as utilities and oil and gas doing pretty well. Since this is an election year, I think starting November, that is around Diwali, you can very well assume that active governance will take a back seat, and the entire country will come into an electoral gear. That is the time, I guess, when consumption will be back. So I guess for the first half, you will have to back spaces such as utilities and oil and gas especially. IT and pharma are secular buys for the entire year because of their export stories. And in the second half of the year, one can look at spaces such as consumption, especially the rural consumption pie, if they have corrected meaningfully in the first half.
Funny, what is your take on United Spirits? 1950 for United Spirits, up 45 rupees, went up yesterday on extremely strong volumes. Now we can endlessly argue whether at the current juncture valuations are justified or not, but the fact that Diageo has taken over, in next 2 years and next 3 years, the complexion of the business surely will change.
Well, that's the general expectation, although I have my own reservations because, as we all know, this entire spirits business is run in a particular way in a country like India. And it will be very interesting to see how the MNC, how any MNC country which has very strong listing guidelines and ethical guidelines in their countries of listing and origin comply with the rules of the game in a country like India.